Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, is there an economic recovery underway? And if there is, what shape is it taking on? And there seems to be some changes in risk tolerance in the market. That's what's on the agenda for today's roundtable. With Steve Reitmeister, our editor-at-large, senior market analyst Charles Rotblatt, and of course that top market technician himself, Kevin Matris. So, yeah, that's an interesting question. What shape is it taking on, this economic recovery? Some say V-shape, some say W-shape.
Yeah, the classic economic recovery from a recession is a V-shaped. You go down very quickly in a short period of time, 2 to 3 quarters of bad economic data. You come out quickly with strong GDP numbers, economy rages higher, and the market comes right along with it. Mm-hmm. There's nothing typical about this recession that we're going through. This is a truly unique phenomenon. It is not quite as bad as the Great Depression, but it's somewhere in between a normal recession and the Great Depression. Mm-hmm. And so I'm leaning a little more towards a W, but I would almost say a little more like a URL, WWW, that I think that it will be hard for us to get, when you think of the V, that strong rebound that just keeps going higher and higher. I think that it's just going to be a little jumpy for a while. Unclear as to how good the economy can be, and will be stops and starts along the way. And with that economic recovery, probably the same for the market. So mostly better than what we've seen, but it's just not smooth sailing the way you think of a V recovery.
Is that how you see it, Charles?
I think instead of a letter, a better analogy might be it's more of a golf club driver where we've come down the shaft of the club, and now we're kind of hopefully getting that little corner, and then we're going to kind of come up a little bit towards the end of the driver, but it's not going to be a huge jump. It'll be more of a gradual rise.
What color is the sky in your world,
Charles? It's a little mauve today. No, but I think that's a good analogy because the thing is, I think we're going to see a recovery based on economic data. But for many Americans, it's not going to feel like a recovery. And I think we're going to look at several periods of very slow growth with rising unemployment. And so although the economic data might show growth, it's not going to be very strong growth, certainly not the 3-4% we've seen before. I think it might be more along the lines of maybe 1-1.5%. And for a lot of people, that won't feel like growth at all.
Yeah, I remember you saying that. Now, you've been sticking with that for the past few weeks, this sideways movement in the market, and jobs data is going to be the last to reflect any kind of a recovery. Kevin?
We kind of have like a mini V going on anyways, because you saw the market go down, then it kind of went sideways for a couple of months, then it collapsed, then we saw the market retrace, and I think the market's going to kind of go sideways to higher.
But I like the golf club thing better.
Yeah, it's. We were talking about this earlier. It looks like a Van Halen symbol. So I kind of think the market is going to go back up to the highs that we had seen back in October and November. I think we are going to get to like right around 9,500, 9,800, whatever. And I think it's going to stay within kind of like a range. What I see happening, though, is, the Fed, they have already kind of, thrown cold water on this recovery. They said with the FOMC minutes, they said that they've downgraded the GDP for this year. They're expecting a weaker recovery in 2010. But again, they did talk about a recovery. So I can see the market going higher, trying to get back to where we were from previous periods. The next quarter's earnings is going to be very, very important. But don't forget, too, we have all of the stimulus money that's going to be hitting later in the year. So I do think that we're going to see kind of like a small little V and then kind of go off to the side with probably an upside bias.
Well, May consumer confidence numbers came out today, the 26th of May, and it took a huge upturn. So what does that mean? Are consumers getting ahead of themselves in this recovery?
If you look at the numbers, they're not quite as bullish as everybody wants them to be. And I'll talk about this more in tomorrow's industry rank piece. But there's two things. First of all, is the expectations index that really drove the higher number. That jumped from 51 to 72. So most people still think the economy is bad now. In fact, 45% still believe the economy is bad. But there's a lot of people who believe that the economy is going to get better and that the worst is over. Curiously, there's about 5.7% that believe jobs are plentiful. I'm not sure where they live or what they're doing.
World
but
they're in, yeah.
It's plentiful for them.
Exactly. I definitely need to move geographic areas and definitely careers. But I think it's worth noting that that big jump in the expectation in the consumer confidence index was really driven by a more rosy outlook, not a feeling that things are better right now.
Okay.
Yeah, just quickly, I'm going to add to that. I think what happens with the consumer confidence, we talk about one of the sides of the market bottom is when everyone becomes numb to the bad information. When you consider how long the economy has been weak, which was really from the end of 2007, people are relatively numb to it if they still have their job, okay, and they've heard about, like the big bad wolf is out there. It's like, this is the worst you have to offer. Right. So for people, they're numb to the information. They're like, if they still have their jobs, they're feeling better about things because they feel like they've already taken the best shot the market or the economy has to offer. And it's like, yeah, it's going to get better.
Right. It's a not quite as bad scenario again.
Right. Not quite as bad.
When you look at the VIX, though, there has been an inverse relationship between the VIX and the market recently.
Well, I was just getting to that.
Yeah.
Hang on. In fact, it's fallen below 30 for the first time since September recently. So a change in risk tolerance in the market, what does that mean?
If you were to look at where the VIX has been prior to, the recent numbers, you can see that it's been making good bases right around the 20-ish area. So 30 is lower than the huge numbers that we had seen, but it's still at a relatively elevated place. But again, seeing the VIX go down, that does suggest that there's going to be less volatility, that there's going to, the chance of a huge move in either direction is probably going to be less likely. But looking at how that applies to the market, I know there's a ton of uncertainty out there, but everybody continues to want to see this correction. Everybody thinks there's going to be a correction, not because they think it's going to result in brand new lows. It's because people are desperately looking for a more opportune place to buy. And I think the market's going to have to go higher before we see this correction. And I fear that people are going to have to chase this market. So there could be some shallow corrections, but I don't think this is going to be the one that sends us even lower. I think you're going to have to move higher before you get that pullback.
Actually, I think he wants to be the host secretly, which is why he keeps getting but that's a different issue. What's this VIX business, Steve? What do you make of it?
We were talking about beforehand, VIX is not part of how I necessarily invest, but yeah, as Kevin said, it's a measure of volatility in the market. The higher the number, the supposedly greater the probability of a large move in either direction. So, now that the market really has been about flat for a month. So we had a big up move and now flat. It doesn't feel like that on a daily basis, but you take a look at it since, and we've been at this 8,000, 8,500 level for about a month. That is why the VIX is coming down. What does it make me change the way my investment approach is going on? The answer is no. It's just an interesting side note. But if you're an options guy, yes, it certainly has something to do with the pricing of options. For a stock guy, it doesn't play into how I take a look at the market. Maybe you guys feel different.
Well, I know Charles watches it, and it's a measure of volatility in the market. And it indicates a change in risk tolerance on the part of investors, right?
Well, I think that's a big thing right there is that traders are less fearful. Now, whether or not they're being complacent or they really think the worst is over is debatable. I do think that when you look at the banks, clearly the federal government, specifically the Fed and the Treasury Department, are determining which banks deserve to survive and which ones, aka Bank United, are okay to fail. But I think the sense that the realization really that the Fed's going to step in and not let Bank of America, not let a Citigroup fail has definitely helped. I think you're looking at, the forecasts themselves for the full year, maybe being overly pessimistic and actual earnings maybe not being as bad as feared. All that's playing into things. So I think people are looking at and realizing, okay, the pace of deterioration is slowing. We're not going to have the absolute worst case scenario I feared, so traders are becoming less fearful. It's worth noting, even though the VIX is at 30 right now, and that's below what we've seen previously, particularly in the fall. Historically, it's still high, but we're really at the lower level, what we consider to be high, so that's a good sign. Before, if we saw the VIX get above 30, everybody get nervous, oh my gosh, the market's going down. And now we're kind of getting to that range where it's more normal volatility, and that itself is a positive for the market. But I think the bigger sign is that traders are clearly becoming less risk adverse, And that itself is a positive sign for the markets.
Still, there's that pesky problem of thin volume in the markets that everybody seems to be focused on.
And I don't think that's going to get any better over the summer. The summer is a slower time of year, so we're going to continue to probably have some big moves on light volume and people unsure of the real conviction of the market for a while.
Volume in the spiders, SPY, has actually dropped for its third consecutive month in May, average daily volume.
Meaning?
Meaning that fewer people are trading, and I think there's a lot of people that are just sitting on the sidelines. And like Kevin described, it's a question: are we going to be in a situation where some people feel like they have to chase stocks, or do some people think maybe there's another shoe yet to drop?
I know I'm going out for pizza. That's it from the round table here with everybody here. I'm Terry Ruffalo.